Most people try to time the market but lose. The truth is, time in the market beats timing the market every single time. Let's talk about something most people get wrong about investing. They think investing is all about predicting the right moment, buying low, selling high, timing it just right. But the reality is very different. Life doesn't give perfect moments, and neither does the stock market. You're busy working, paying rent, trying to stay ahead of bills. You don't have time to read charts or guess market dips. Most Americans live paycheck to paycheck. Credit card debt is rising, rent is expensive, and savings are shrinking. So when you finally manage to save a few $100s, you don't want to mess it up. That pressure makes people wait for the perfect moment. But in that waiting, they miss the most powerful force in investing. Time. Not timing, just time. Because the longer your money stays invested, the more it grows. Slowly, quietly, but powerfully. A lot of people believe they have to wait for the perfect dip to invest. They think if they don't buy at the lowest point or sell at the highest, they'll lose. That belief creates fear. It causes delays. People wait, and they never get started. The truth is, nobody consistently gets timing right. Not even professionals. Trying to predict the market is like trying to catch lightning in a bottle. The correct mindset is to start investing as soon as possible and keep going. Consistency beats perfection. For example, someone who invested $100 every month for 20 years without ever trying to time the market would likely have more money than someone who waited for the perfect moment, but only invested occasionally. Time in the market allows your money to grow through compound interest. Each year your investment earns returns, and then those returns start earning more returns. That's how wealth builds, slowly but surely. Timing the market might work once or twice, but missing even a few of the best days can destroy your returns. The truth is, most of the market's gains come from a few random days. If you're not in the market on those days, you miss out big. The right mindset is to stay invested and let time do the work. A real example is someone who stayed invested in the S&P 500 from 1990 to 2020 versus someone who missed just the best 10 days. The first person made over double the return just by being present. People delay investing because they fear loss. They want guarantees. They say they'll start next year when things are better. But every year you wait is a year you lose compound growth. The stock market doesn't wait for anyone. It just keeps moving. The correct mindset is to invest early even if it's a small amount. The earlier you start, the more time your money has to grow. For example, someone who starts investing $50 a week at age 25 could retire with over $1 million. But someone who starts at 35 might end up with half of that. The difference isn't how much they invested, it's how long it had to grow. Emotions trick you. When the market crashes, people panic and sell. When the market rises, people get greedy and buy. But by the time you feel like buying, it's usually too late. And when you feel like selling, it's often the worst time. Emotions don't align with smart investing. That's why timing is so risky. It turns your money game into an emotional roller coaster. The right mindset is to ignore short-term noise and focus on long-term goals. For example, when the market dropped in 2020, a lot of people sold in fear, but those who stayed invested saw massive gains just a year later. Time rewarded them. Instead of timing the market, you can invest the same amount regularly. That strategy is called dollar cost averaging. It removes emotion. It makes investing a habit, not a gamble. Whether the market is up or down, you keep investing. Over time, you buy more shares when prices are low and fewer when prices are high. That averages your cost. It's simple. It's powerful. It's how everyday people build wealth. A real example is someone who invests $200 every paycheck for 10 years. They'll likely build more wealth than someone who tries to pick and choose perfect days. There's a famous saying in finance: the best time to invest was 20 years ago. The second best time is now. Waiting doesn't help. Worrying doesn't grow money. Action does. Even if you start small, what matters is that you start. The correct mindset is progress over perfection. For example, investing just $25 a week might not seem like much, but over decades, it can become tens of thousands. Time turns small steps into big results. Markets go up and down. That's normal. There will always be recessions, crashes, recoveries, booms, but the long-term trend of the market is up. History shows it. Over the last 100 years, the US stock market has always recovered. Timing the bottom is impossible, but staying invested through the ups and downs always pays off. The right mindset is patience. A good example is someone who invested before the 2008 crash. Their portfolio may have dropped in value, but by 2013, it was back up and growing stronger than ever. Time healed it. Retirement isn't a lottery. It's a long game. You don't need a secret formula. You need a plan and time. Starting in your 20s or 30s gives you decades of compound growth. Even if you miss some years, it's never too late to start. But the earlier, the better. The real truth is, financial freedom isn't built in a year. It's built over decades, like building a house one brick at a time. For example, someone maxing out a Roth IRA from age 25 to 60 could retire with over $1 million. That's not luck, that's time. You don't need a lot of money, you don't need perfect timing, you just need to start. Pick a low-cost index fund, set up auto-investing, choose an amount you can afford every week or month. And don't stop. Don't panic when the market dips. Don't celebrate too early when it spikes. Just stay steady. That's how wealth grows, slowly and surely. For example, using apps like Fidelity or Vanguard or even Robinhood makes it simple. Start with what you have. The rest comes with time. The biggest investing mistake is waiting for the perfect moment. The truth is, there's never a perfect moment. There's just time. And every year you stay invested gives your money more power. Compound growth works like gravity. It pulls your wealth upward with enough time. Timing feels exciting, but it's unreliable. Time feels boring, but it works. If you want to build real wealth, start now. Start small, but stay consistent. Don't try to predict the market, just participate in it. Money grows best when you give it time, not tension. Your job is not to outsmart the market, it's to outweight it. If you found this video helpful, make sure to like the video, subscribe to the channel, and share it with someone who needs to hear this today.